Long-term capital management began trading on February 24, 1994, founded by John Meriwether, the former vice chairman and head of bond trading at Salomon Brothers. Its board included Myron Scholes and Robert C. Merton, who would share the 1997 Nobel Memorial Prize in Economic Sciences for the option pricing model that underpins modern finance. David Mullins, a former vice chairman of the Federal Reserve Board itself, left the Fed to join them. With just over $1 billion in starting capital, it was one of the most credentialed money management teams ever assembled. The strategy was called convergence arbitrage. The fund used quantitative models to find tiny price gaps between closely related bonds and bet those gaps would close. The catch is that the gaps were only a few basis points wide, so the way the firm turned pennies into fortunes was enormous borrowed money. It worked beautifully at first, with reported returns after fees of roughly 21% in 1994, 43% in 1995, and 41% in 1996. By the end of 1997, the fund believed the easy opportunities were drying up, so it returned about $2.7 billion of capital to investors, cutting its capital base by roughly 36% to about $4.8 billion. But it did not shrink its positions to match. Returning capital while keeping the same trades mechanically pushes leverage higher on a thinner cushion. This was the loaded spring the fund carried into 1998. At the start of 1998, the fund held about $4.7 billion of equity against roughly $129 billion of assets, a balance sheet leverage ratio above 25-1. Off the balance sheet, it carried derivative positions with a notional value reported at well over $1 trillion across more than 60,000 separate trades. An equity base smaller than $5 billion was steering more than $1 trillion of exposure. The model suggested this was manageable because the bets were diversified and were assumed to move largely independently. The trouble started before any headline crisis. The fund lost about 6.4% in May 1998 and about 10.1% in June, draining roughly $461 million of capital. June was its worst month to date. The cushion was already thinning when, in July, the bond arbitrage desk at Salomon Brothers began liquidating its own portfolio of nearly identical convergence trades, pushing down the prices of what the fund owned and bidding up what it had sold short. On August 17, 1998, the Russian government devalued the ruble, declared a default and moratorium on its domestic ruble-denominated treasury debt, and imposed a 90-day moratorium on certain payments by Russian banks to foreign creditors. The fund's direct losses tied to Russia and other emerging markets were modest, about $430 million of the eventual damage. But the default lit a fuse far longer than that direct exposure because of how the rest of the world reacted. The default triggered a worldwide flight to quality. Investors dumped anything risky or hard to sell and crowded into the safest U.S. treasuries, so risk spreads and liquidity premiums blew wide open instead of converging. That was the opposite of the fund's central wager. Bets the models treated as largely independent turned out to share one hidden factor: the price of liquidity. So their correlations jumped toward one and positions lost together rather than offsetting. On August 21, 1998, the 10-year swap spread spiked about 21 basis points in a single session. Combined with equity volatility losses, that one day cost the fund roughly $550 million, its worst day ever. By the analysts who later studied it, this was a loss so far outside the fund's risk models, which were calibrated on only about 5 years of recent, relatively calm data, that one assessment said it should scarcely have happened in the life of the universe. For the whole of August, the fund lost about $1.85 billion, close to 45% of the capital it had left. Now the feedback loop took over. Rising volatility led counterparties to demand more collateral, so the fund had to sell its most liquid hedges first, leaving the illiquid positions exposed. Forced sales pushed prices lower, which raised measured volatility again, which triggered still more collateral calls. In the first 3 weeks of September, equity collapsed from about $2.3 billion to roughly $400 million, while the asset base stayed above $100 billion, sending effective leverage past 250-1. This was no longer one fund's problem. The fund financed itself through repo with about 75 counterparties and held derivatives with roughly 50 more, meaning it owed money to nearly every major bank on Wall Street. The president's working group later reported the fund's own estimate that its top 17 counterparties could face combined losses of $3 to $5 billion if it failed in disarray. A single fund's collapse could detonate cross defaults and a fire sale that would punish firms that had never even traded with it. On September 22, 1998, William McDonough, president of the Federal Reserve Bank of New York, summoned the heads of Wall Street's biggest firms to the bank's boardroom. His documented fear was that a disorderly unwind would snowball through markets and inflict losses on firms with no direct tie to the fund. The next day, a competing private offer from Goldman Sachs, AIG, and Warren Buffett, about $250 million for the partners plus $3.75 billion in new capital, was put to Merriweather with under an hour to accept. The deadline lapsed. Around 6 p.m. on September 23, 1998, 14 financial institutions agreed to inject about $3.625 billion in exchange for 90% of the fund. 11 firms put in $300 million each, with smaller sums from Societe Generale, Paribas, and Lehman Brothers. The Federal Reserve organized the deal but lent none of its own money. In testimony days later, Greenspan said the goal was to prevent a fire sale liquidation that could cause severe, widespread, and prolonged disruptions to financial market activity, stressed that no Federal Reserve funds were provided, and warned that abnormal returns are sustained only through abnormal exposure to risk. The partners' fortunes were wiped out, the portfolio was wound down, and the fund effectively closed by early 2000, and reporting indicates the rescuers were ultimately repaid. But the deeper concern was the precedent. By orchestrating a rescue for an institution seen as too connected to fail, authorities raised a moral hazard worry that they would backstop big, interconnected firms. Instead of tightening derivatives oversight, Congress later passed the Commodity Futures Modernization Act of 2000, which exempted most over-the-counter derivatives from regulation. Many commentators link that precedent and that opacity, the same dynamics of leverage, hidden correlation, and counterparty webs, to the far larger crisis of 2008. Some of the most respected minds in finance, with Nobel Prizes and roughly 25-to-1 leverage, were destroyed in weeks. So the takeaways for an ordinary person are simple and unglamorous. Be very cautious about borrowing to invest, because high enough leverage can turn even a temporary drop into a permanent wipeout when a margin call forces you to sell at the bottom. Keep an emergency fund so you are never a forced seller, and treat any strategy promising high steady returns with low risk as something to question hard, since it may hide leverage or a tail risk you cannot see. Buffett and Munger had declined to invest back in 1993, judging the leverage plan too risky, and that caution is worth remembering.